I'd now like to ask the managers, how did you manage COVID and then the recovery? And I'll kick off that question with Matthew. Thank you.
So our performance through 2020 was resilient to the COVID pandemic, and we were able to continue to pay those consistent dividends throughout, and we actually delivered a NAV return of 7.7%. The very nature of our strategy being senior secured, combined with the resilient asset class and structural protections that we use, means the risk of volatility at times of heightened financial stress is considerably lower. And we think the strength of performance of the portfolio was also evidenced by the cash generation that Honey achieved in 2020, where it generated 291 million of cash, which was actually higher than the cash generation in 2019. During the height of COVID, we put a pause on all new investments, and we used the cash generation to reduce gearing in the trust. And then as the impact of COVID on the economy became clearer, we were seeing opportunities that we thought offered pretty compelling risk returns with strong asset backing. So we started to redeploy capital in the latter half of 2020. If we look ahead to COVID-19 and the ongoing impact it's having, we think that it's only served to accelerate some of the structural changes that are happening in our market and our industry. And it continues to narrow the focus of the mainstream banks. And we think that provides opportunities for non-banks to continue to grow and therefore our market to continue to grow.
Right. So actually, bizarrely, COVID actually created some opportunities for you, actually. Would you agree with that?
Yeah, no, definitely. The structural changes that have been happening since the financial crisis, kind of COVID has only exacerbated some of the larger banks' issues. And it means that they've continued to pull out of markets that are kind of core to kind of SMEs and consumers, and non-banks are filling that gap. So we definitely think the disruption is creating opportunity.
Interesting. Joanne, how did you manage COVID and then the recovery?
Yeah, so at the onset of COVID, we kind of sat down and looked at our portfolio and worked with our independent valuation agent to agree some discount rate changes, which we thought was a really prudent approach to take at the time, given that we didn't really know what the impact might be across a number of different sectors in our portfolio. And we classified our loans as high impact, medium impact, and low impact. And then over the last 18 months, we've been able to unwind a lot of those provisions, which has been really positive, actually working with those borrowers to see that they can actually work through the impact that they were having on their businesses. And really, we've been really impressed with the management teams that we've worked with and how they've been able to manage those challenges. It has also opened up a number of opportunities for us as well, where borrowers within our portfolio have seen opportunities in their sectors. So, for example, to grow their businesses. So, for example, the care homes that we were working with are looking at new properties that they can develop into, and the children's nurseries that we support are seeing opportunities for them to grow as well. It has meant that as a fund, whilst we would normally be raising more capital, we haven't been able to do that over this period. So what we've been concentrating on is really effective redeployment of our RCF when we're getting repayments back through the fund. And we had a really positive year for origination last year as well.
Excellent. So opportunities for you too. Excellent news. And Thomas, how did you manage COVID and the recovery?
I'd say we've managed COVID pretty well. And the board and the investment management team were very quick to react and anticipate to the effects of the pandemic. First and foremost, and on a temporary basis, we suspended all new lending activities. And our key focus was very much the existing portfolio and making sure that we were preserving capital. But in addition to that, we wanted to make sure that we were providing the level of support to the investments as well as the company's management, whether that was in the form of providing covenant reliefs where it was deemed necessary without necessarily releasing some of the other control mechanism and other key covenants that we have in the legal documentation, whilst at the same time preserving in full our interest income. I would say that the fact that we've kept our dividend distribution consistent since inception of the fund, even throughout COVID, just shows investors how robust the portfolio was pre-going into COVID, during COVID, and after COVID. I would say, in addition to that, the status of the portfolio and the credit profile of our underlying investments or very well positioned for the reopening of the economy. In fact, I would go a step further than this and really state that the state of the portfolio is in a far better shape than where we were pre-COVID and during COVID. And I think that's fully reflected within the NAV market that we've seen over the various months. And we fully expect this momentum to keep going over the remaining of 2021 and 2022. Also, what that's meant is obviously we were pre-COVID seeing a lot of structural and social demographic changes, which ultimately created a lot of compelling opportunities for us. And really, COVID has just enhanced those changes, which really creates for the fund and ultimately for investors a very compelling opportunity set. And I would say one of the most promising opportunity set for the fund since the inception, allowing us to generate very attractive risk-adjusted returns within our core sectors, i.e. social and environmental infrastructure.
Yeah, that's very interesting. I think it's very interesting the point you make about the sustainability of the income through the pandemic. I think it showed that your risk controls and your strategy is working to have that.